Thank you for joining this webinar. My name is Russ Mould. I'm AJ Bell's Investment Director, and today we'll be looking at how to try and earn income in 2020 and beyond at a time of record low interest rates, very low, if not record low, government bond yields, and also wide-ranging equity dividend cuts in the United Kingdom and the United States in particular. So this is what we'll be talking about: the global backdrop, cash and bonds, the global backdrop for equity income. We'll then hone in particularly on UK equity income, an area to which I'm sure many clients and advisors have considerable exposure. Then a quick look towards the future and hopefully a few useful conclusions. So global interest rates, this is our starting point. This looks back basically 25 years, back to summer 1996. And even now, 15 years ago, it's almost hard to believe, we could have picked up 5.5% for owning a UK 10-year government gilt or bond. That now looks like picking money up in the street, particularly when it is a historical fact that the UK has not quiched on its debt, it's not welched on its lenders since King Charles II and the stop of Exchequer in 1672, although you could argue that the refinancing of the war loan in the 1930s was a quasi-default. That's not how it's recorded in the history books. But where we are now, well, there have been attempts to raise interest rates. The Fed did try in 2016, 17, 18 and 19, but that big, thick black line, it's had to quickly recant. And overall, the trend is very clear. Top left of the chart, down to bottom right, and it leaves us pretty much with interest rates at or near zero in all of these major developed markets and quite a few more besides. So when it comes to getting income, cash is a pretty tricky place to find it. And even with inflation wobbling around the 0.5 to 2% level in much of the developed world, that is enough to erode the gains on which we can make from cash in the bank. So that is an income option, is a difficult one. Doesn't mean that cash does not have a role in a balanced portfolio. You may feel for you and your clients that a small guaranteed after inflation real terms loss is a much better deal than risking money in, say, equities or government bonds or commodities if you're frightened of a big capital loss there. So it could still be a relative decision, and cash still brings optionality, a chance to dip in when markets have had a wobble, as they did quite remarkably earlier this spring. So it's not to say that cash has no role at all, but in terms of income, its role is fairly limited. As ballast and optionality, it still has a role to play if you feel it suits client needs. And why are interest rates where they are? Well, this is the chart. Again, the bar shows global interest rate increases from global central banks. The red line is cuts. And in 2017-18, there was a gathering sense. The world economy was relatively strong. Central banks were trying to raise interest rates. The Fed again led the way, but we'd already began to see some trouble with that in early 2019. And remember that the Fed turned fast very quickly when financial markets turned very volatile in late 2018, early 2019. But there was a big fast by the US Federal Reserve, and again, Fed cuts have led the way. The situation's been compounded by the COVID-19 outbreak and the policy response of lockdown, with the result that we've now had 133 central bank interest rate cuts this year and just 4 increases. And so that's largely why those hopes for higher returns on cash have been snuffed out. You could argue that there was the momentum had shifted anyway even before COVID. Much of the economic growth we'd seen for the last 5 or 6 years was built on debt, so you could argue that the foundations were relatively brittle, but certainly COVID has not helped, and it's certainly accelerated the trend towards rate cuts. That has in turn influenced government bond yields, as you would expect. This is the 10-year yield from all of, again, the 4 major areas that we looked at to start with, and the trend is exactly the same, top left down to bottom right. This time on a 30-year view, whether it's 25 or 30, the trend is the same. Negative rates in Japan and certainly very nugatory ones in the UK, Germany, in the United States. So again, sovereign fixed income for income hunters is now relatively low territory. You may still feel that there is money to be made on a capital basis, given that central banks are still running quantitative easing schemes hand over fist, and you may be happy to rely upon the greater fool theory that they are price insensitive buyers. So again, This is not to say that fixed income has no role in a balanced portfolio. It's just that from an income perspective, it's pretty tough sledding. Naturally, other bonds trade off government bonds, and so you have seen this similar top left, bottom right, grinding lower trend in yields, with the odd panicky exception, the big spikes that we saw there, 2000, 2007 to 9, and indeed earlier this year. But overall, the trend has been down as investment grade corporate debt and high yield government, high yield corporate debt or junk, their yields have come down too. Again, there is a relative trade-off here. Advisors and clients looking for income can get higher yields, but the trade-off is on balance more risk, particularly if you start looking at, say, emerging market debt, either in hard currency or local currency terms. And if you start looking at junk debt, for example, I mean, that big spike in junk debt back in the spring probably meant that the risk reward was heavily slewed in favor of reward by picking up some junk debt, particularly once the US Federal Reserve jumped in and started buying it. But nevertheless, if you do want income, I'm afraid to say it does mean there is going to have to be higher risk taken, whether it's in the form of real estate investment, more risk relative to cash and bonds, whether it's in the form of real estate investment trusts, whether it's in the form of equities, whether it's in the form of junk debt, for example. So there are options out there. This shows the options that were available in equities as we went into the COVID crisis. And I've put this cut-off point here at the end of March very specifically. You can see the major geographic options available to advisors and clients here on a dividend yield basis. Some interesting ones down at the bottom that you might not necessarily think about. I mean, the US relatively low yield market is relied much more heavily on share buybacks, which probably broadly doubled the return from dividends alone in the last couple of years, but they're now drying up for fairly obvious reasons. Asia, perhaps a slightly underexplored option for equity income. Western Europe is a very deep pool of dividend payers. And then right at the top, the fattest yields, Eastern Europe and the UK. Eastern Europe very heavily dependent upon Russia from a market cap perspective. Russia in turn heavily reliant upon oil companies, so you can see what's coming next, given that oil prices collapsed shortly after this chart was cut off. And then the UK pretty much at the top. So it was awfully tempting to think that for all of the risks involved, the UK was potentially a good source of equity income. But of course, we've unfortunately been here before, and we've seen what's happened in the last 3 months. When you've seen a welter of dividend cuts, it's now something like 350 dividend cuts from stocks in the UK market over the last 2 to 3 months. 46 FTSE 100 companies have cut against just 32, or cut or deferred or suspended or even cancelled their payments, to be more precise, against 46 from the against 32 retaining. And we have been here before. In his magisterial Cambridge Economic History of Britain, J.H. Clapham warned of the dangers of blind capital seeking its 5%, using as an example the Victorian railway boom of the 1840s. So we have been here before. Interest rates were at zero. There was affluence in the air, and Victorians were looking for somewhere to put their savings and get a decent return. And the railway boom came along, offering stocks with coupons or yields of 5% or more, and that actually worked pretty well for a big chunk of the decade, until the railway building program began to come to an end. The boom burst, building stopped, Ponzi schemes emerged. My hometown of York, George Hudson was pretty much found out running a Ponzi scheme, funding coupons for existing investors with money coming in from new ones. And eventually coupons were cut, prices crashed, and that 5% coupon or 5% yield didn't prove to be anything of the sort, and capital loss insult was added to the loss of income injury. So unfortunately, I'm old enough to have been taught that, having started my career in 1991, that any dividend yield that was more than 1.5 times the 10-year government gilt yield was possibly too good to be true. Well, that's probably been thrown out now, because with the 10-year gilt yield of 0.2, 0.25%, that means anything of 0.4, 0.5% or high is untrustworthy. Well, that probably doesn't apply, but certainly anything offering 5, 6, 8 to 10%, you would certainly have to look very carefully at. And so it has proved. Some big stocks, Vodafone, Marks and Spencer's, Royal Mail, Centrica, all offering in theory all in theory offering double-digit dividend yields, in the end actually weren't doing so. So although there was in theory an opportunity there, it turns out that from an equity income perspective, the UK has almost been a bit of a value trap. Here are the statistics. They've actually moved on in the week since I've drawn this chart. The total cuts is now £30.7 billion, and the total of retentions is about 13. But you get the picture. It's been pretty brutal work out there if you're an equity income fan. And in fact, that 5% plus dividend yield as well, or 6% plus dividend yield almost that we saw being offered on paper at the end of March is now probably something like 3 to 3.5%. So like my football team, good on paper, not so good in reality. So why though has it gone wrong? I think there are some fairly simple explanations here. This chart on the left shows you now how things are looking. Probably, 2018 now may well turn out to be a peak for some time for UK equity dividend payments, depending upon the extent of the lockdown, the pace and degree of the economic subsequent recovery, and let's hope that there is one. Something around 81, 82 billion pounds of dividends paid, excluding specials in 2018. Analysts had originally been looking for an increase to 89 billion in 2019 and 92 billion in 2020. The current consensus forecasts are now, with the books almost closed on 2019, coming in about 73 billion, and 2020 coming in at just over 60 billion. And that's still got some fairly potentially fruity hopes in there, including that people like the banks, for example, start paying dividends very late on in their financial years before a recovery in 2021. But what's gone wrong? Too much debt, too many share buybacks, financial engineering and jiggery pokery, and also, as we'll discuss later on, a lack of breadth in UK dividend income, of a concentration of income on a very narrow number of companies. So it's possible that a common or garden recession would have done quite a bit of damage here, but in the end we didn't get a common or garden recession. We got something unforeseeable and really quite frightening in terms of the COVID-19 outbreak and then the lockdown response, with the result that corporate cash flows are just being found to be really just too brittle to withstand certainly that sort of treatment. But even just a normal recession may well have done it. So what do I mean by increase in net debt? Well, this excludes the big five banks who have been good citizens. They have deleveraged under pressure from regulators, shareholders, central banks and politicians. They've been doing their job, but as interest rates have gone lower, companies have understandably taken on more debt, whether it's to acquire, whether it's to invest, although that's possibly been less prevalent than we would like to see, as we'll see in a moment, unfortunately, in some cases, to indulge in some financial sleight of hand with share buybacks. But broadly speaking, FTSE 100 net debt is up from just over 250 billion to just over 450 billion over a decade since the financial crisis, an increase of some 70%. So not surprisingly, when there's trouble comes in the form of a recession, the defences are somewhat down, even just a normal recession, let alone the spectacularly deep and speedy one that we've had, or are having. Part of the reason for that debt accumulation is here, buybacks. Now, this isn't a perfect calculation because it looks at net proceeds returned using the data from Bloomberg. So that offsets share capital raised from investors, which the net raising would be above the line, and buybacks then would go below the line. So overall, as you can see, 8 years in 10, there have been more buybacks and de-equitization, to use a terrible neologism, than there has been capital raising. Now, I was always brought up to believe that stock markets were there for the raising of capital to help companies invest and grow, not to shrink. So whether this turns out to be a wise course or not is open to question, but it's understandable. If you can borrow money cheaply, buy back your shares, goose your earnings per share figure and get 5 to 10 points on your share price, it's a pretty easy arbitrage for a finance director or CEO looking to goose their stock and stock options. So it's understandable how it's happened. Whether it's right or not is another matter entirely, but the net result again has been that accumulation of debt. Money has gone out the door in buybacks, which means there's been less left in the pot for dividends when push has come to shove and trouble has hit. And then ultimately, really, companies have been not only returning too much cash through buybacks, you could argue they've been returning too much cash through dividends, because dividend cover overall has been relatively low. You would like it to be at 2 times broadly to give you comfort or buffer in case something unexpected goes wrong, like a recession, let alone something as unexpected as a pandemic. And we can see here that UK cover got down to barely 1.3, 1.4 times 4 or 5 years ago. It started to rebuild very slowly, but companies probably have been over distributing their profits. Why? curry favour with shareholders, aware of the fact that people are screaming out for income. So it's a way again of keeping a loyal shareholder base and helping your share price, and also of course managers themselves may be investors, so there is a vested interest there too. But that's a pretty tricky combination: buybacks, debt, over distribution, and then to cap it all, lack of breadth. Now this is where forecasts are right now after all of the cuts that we've seen according to consensus analysts' forecasts. And you've got 20 dividend payers here forecast to offer 46 of the £63 billion in dividends up for grabs in 2020, in theory. Basically, 3/4 of the income comes from these 20 names. So your selected fund managers, or you yourselves, if you're looking at exposure to this through passive instruments, will need to be pretty careful and pretty confident that these 20 are going to do the business for you if you are going to use the UK as a destination for equity income. Now, right at the top of the list is BP, 11% of the FTSE total. New Chief Executive Officer Bernard Looney's come in with a new strategy to greenify BP, make it much more adapted to a zero net carbon neutral future. Thankfully for him, oil has bounced enormously back to $40 a barrel, but it's still not really where it needs to be for that £7 billion a year payment to be truly sustainable. So Shell has shocked everybody by cutting for the first time since 1945 this year. BP has got every context to do so. New boss, new strategy, big increase in debt over the last 10 years, and a weak oil price. So if you're looking at those 20, automatically you get to the top of the list and you're starting to get a little bit wobbly-legged already. Then in the event of a long economic downturn, you'd have to raise questions over the miners, and you've still got some banks in here who are being told not to pay dividends in 2020. The reason, by the regulator, the reason that HSBC, for example, gets in here is it could declare a dividend for fourth quarter 2020 fiscal, which will be declared and paid in, yes, you guessed it, calendar 2021. So there is a way around it. But as a passive investor in UK equities, or somebody who's given money to fund managers, to active managers to seek equity income, these will be the first 20 companies they look at because they're the biggest payers. So they will be having to take very clear views on which of these can get through the downturn and keep the dividend payments coming, and which of them may still be at risk, because the UK showed very narrow breadth going into the downturn, and it has very narrow breadth now, albeit with a few different actors at the top of the list. So in terms of the future, unfortunately, none of us know what's coming. We don't know whether the COVID outbreak will last for a long time or not, whether the vaccine will work or not. Because let's face it, most flu vaccines don't have a 100% track record. We don't know what government policy response is going to be. We don't know what the public response will be when indeed they are unlocked. And then in terms of policy response, well, research from Bank of America suggests that there's over $20 trillion of fiscal and monetary stimulus being addressed to the global downturn. If you take the forecast from, say, the World Bank or the IMF on trust, that we're looking at a 10 to 15% drop in global GDP this year, then that is roughly a loss of $9 trillion of global GDP, and $20 trillion has been printed, created, generated to fill that hole. So that's why some people are actually talking about an inflationary upturn, because you've had, in addition to all of this fresh money creation, you're potentially getting a supply side shock as global supply chains are fractured. People want to start sourcing much more closer to home rather than, say, from Asia or from Latin America, for example, with the result that there could be inflation. Equally, you have some people who argue that the result is going to be deflation because you've had a massive demand side shock. Yes, the furlough scheme has kept people in employment, but there remains a danger as that scheme is eased off and the whole leisure and hospitality only recover slowly. There'll be substantial loss of jobs, loss of income, a big demand side shock, and then add that to all of the debt that was already in the system, with global indebtedness having grown by 70% to a record $250 trillion worldwide since the financial crisis, and the extra government debts piled up in response through fiscal policy. Some people will argue that deflation is coming, and some will say, well, they'll sit on the fence and say that stagflation is coming, a return to the 1970s, limited economic growth, and yet inflation as a result. And there is still debate as to whether we get a V W, U, L, bathtub, tick, or any other shaped recovery. Of those three major scenarios, all would on balance require different portfolio solutions. Inflation would lead you probably more towards commodities and real stuff with a dash of equities. Stagflation, if anything, the basis of the 1970s tells you anything that really works again, real assets, gold, precious metals. Deflation, actually, you probably want to be in cash and bonds even now. So again, very diametrically opposing solutions to a wide range of solutions, and we just simply don't know what's coming. As our friend here, Voltaire, would state, taking too strong a view on anything could just get you into a little bit of trouble. So a balanced portfolio, range of assets, even still possibly cash for the optionality, might make sense for some customers and some clients, depending upon their personal financial needs and goals. But just to flag one possibility to think about, it's a niche area, one that some people will like and one that some people will just switch straight off. If the problem at the moment right now for a lot of companies is cash flow is being crimped, which is limiting their ability to pay dividends and certainly forcing in many cases cuts, cancellations, or deferrals, one sector where cash flow has blossomed over the past 3 to 5 years is the gold miners, the precious metal miners. This is the Hui Gold Bugs Index. It just looks at the 10 biggest stocks in that index, which is a New York Stock Exchange index, and you can buy passive instruments that track it if you feel it's appropriate for long-term investment strategies. And it just shows that the cash flow here is multiplied by a multiple of over 5 times since 2015, with the result that dividends are starting to blossom as well. The 2020 number just annualizes the payments declared for the first quarter of the year, and we're still nowhere near the dividend levels that were paid out in 2011-12 when gold reached $1,900 an ounce. It's hanging tough right now at about $1,700 an ounce. Now, your biggest risk clearly is the gold price goes down, that cash flow shrivels, and the dividends don't come through. But even if they do, a dividend yield of 1.5% to 2% isn't necessarily going to get too many clients dancing on tables, but it could still grow nevertheless. It's something that's worth considering. And as to whether gold is a hedge against inflation or deflation, I don't know, to be honest with you. What I suspect, if you look at the way gold has performed since 2000, you would possibly argue it's a hedge against central banks not being on top of the situation. And that's not to blame them. Nobody, again, could have foreseen what's happened this year, but their response has been phenomenal. They're trying to get ahead of the curve. We don't know whether they're ahead of it or behind it, but there's certainly a sense that nobody knows what's coming next. So I think that we're the best one in the world. Jay Powell, the Fed chair, said a couple of weeks ago, he doesn't know what's coming next. He's hopeful of a recovery, but couldn't promise one. And that's why he's still running monetary policy flat out. Fed's balance sheet has gone from 4 to 7 trillion US dollars in barely 14 weeks. So I think gold may be a hedge against the authorities just not knowing what's coming next. And as we've just discussed, none of us do know what's coming next. So it may have a role in a balanced portfolio for certain types of clients. Now, many of them may agree with Buffett. Gold, inert metal, no industrial use. If a Martian fell over it and stubbed their toe, they'd just swear and wouldn't know what to do with it. But equally, gold miners can generate the cash that could potentially excite some investors and clients, and indeed generate at least some little bit of dividend yield. And this again just shows that Fed balance sheet expansion. It's again just in the week since I've drawn this chart now crept above 7 trillion US dollars. And I've noticed again those periods when there has been fear and the feeling that the Fed isn't in control and it's really turned on the taps when it comes to monetary policy. 2008 to 11, lo and behold, gold went bananas and nearly reached that $1,900 mark. And then gold came back as the Fed's balance sheet began to flatten off. There was even talk of withdrawing stimulus, but as soon as they've had to press the print button again, gold's been back off to the races. So this is a trend worth watching. If the Fed is able to start slowing down balance sheet expansion, or perhaps even more surprisingly withdraw it, that would put a lid on gold and probably invalidate the last 3 slides. But given that the Fed, Bank of England, Bank of Japan, and European Central Bank didn't get around to withdrawing the stimulus they put into the system in 2007-9, it'll be intriguing to know how many clients would want to take the bet that it'll be capable or willing to withdraw the stimulus after this crisis is over. So by way of conclusion, to keep this short and snappy, clients' need for income will, of course, depend upon their overall strategy, their target returns, their time horizon, and appetite for risk. Younger clients will probably still be in capital appreciation mode, but equally, income can give total returns a very useful boost through accumulation units for funds and dividend reinvestment. So it still has a legitimate role to play, even for the most patient and long term of clients. But as we've discovered at our cost in the last 3 months, and indeed in many historic incidents before, finding safe income is not as easy, and there has to be a clear trade-off between risk and reward. The more income you wish to harvest, you probably are going to have to take more risk and go up the risk curve and try and do it in as measured a manner and diversified a manner as you can. Equity income is one option. You could still look at global REITs, for example. You could still look at investment grade debt or junk debt. Again, whatever you feel fits your customers' particular needs and appetites for risk. And equities are still a valid option, even in the UK. But again, you need, if you're looking at the UK as a source of equity option and of income, and the yield's probably 3 to 3.5% right now, if those analyst forecasts are any good, you've still got to be aware of the concentration risk and the need for your fund managers, or yourself if you're going in there through passives, to look at those 20 names, those oils, those miners, those banks and insurers, and a couple of drug companies and utilities, to make sure that you're completely confident in their ability to pay. Otherwise, even that 3.5% dividend yield could turn out to be a little bit of a chimera. Clearly, the quicker the lockdown is eased, and the quicker it is eased safely, and the quicker the economy can start to make progress, the more helpful that would be for Equity Inc., for corporate cash flows and equity dividends. Second waves, third waves, whatever, and further tightening of lockdowns and response would clearly be potentially troubling in many ways, to say the least, but also from the narrow perspective of equity income. And also, I'm sure one thing that your fund managers are looking at is politics, or more pertinently, public opinion. Companies who are seen to be accepting government assistance with one hand, VAT holidays, business rate holidays, furlough schemes, for example, for them to then turn around and to take that money in with one hand and then hand out cash in dividends to shareholders with the other, I think that'll look pretty odd, and I'm sure will be looked at askance. I mean, Tesco's did get some questions about it with its full year dividend. I think they're able to back that away because they just sold the business in Asia for around £8 billion. So they could argue the money's come from there, but it still looked a little bit funny taking business rates relief for over £500 million and paying out dividends worth over 600. So it'll be intriguing to see just how much of the public and how many politicians keep a track on those things. I suspect possibly more than some management teams would like to think, and that is going to be a further variable for your chosen fund managers to watch. So I appreciate that's a bit of a whirlwind tour of income, equity income in the context of record low rates, record low government bond yields, and this minefield that we've encountered in terms of dividend cuts, particularly in the UK and to a lesser degree in the US. But I hope it was useful. I appreciate all of your time. I hope that you, your friends, family and colleagues are all keeping well and in good spirits as best it can be during these difficult times. And I look forward to talking to you again in the future. Keep well, and thank you.